Erik, are you there? I think, Erik, you might be on mute. Okay, we see your slides there.
Yeah, we're good now.
Yeah, that's all yours.
Yeah, thanks for the introduction,
You're
Anthony. And we'll
welcome.
started. I've got 45 minutes. Is that correct?
Yeah, that's correct.
Okay, let's get the show on the road. We've got a lot of material. Thanks for having me. Thanks for being here, everyone. We're going to look at automated options trading for really any market condition, including non-directional strategies. We'll use automation to help us along the way. So we're not going to be chart watching. And we have one-touch responsive trade alert technology. You're going to like to see that. And with that said, take a look at the risk disclosure. It is important to keep in mind that when trading, only risk capital should be used, and that past performance is never a guarantee of future results, and there's always a risk of loss when trading. You can take a screenshot of that if you'd like to read all the details later on. Okay, a little bit about Altavest. We've been doing this since 1997 as a registered introducing brokerage firm. We developed our own proprietary options technology, trading millions of contracts along the way. We're registered with the CFTC and members of the NFA. We're located in California. And I am Erik Gebhard. My business degree from University of Southern California. I'm a co-founder of Altavest. I've had various securities licenses over the years. Currently have my Series 3 for commodity futures, and then also the Series 65. That's what registered investment advisors would be using. Perhaps you've seen us in some other presentations on the web and even maybe in person. In fact, here's a shot from few months ago in Miami. There was about, I think they said about 1,000 people in the audience. So I presented there, and that was a lot of fun and met a lot of great people as well. And sometimes we get quoted on various publications and financial journals. Here we are just a couple weeks ago in the marketwatch.com asking us our opinion on, I think, gold and the S&P and maybe even treasury bonds. But that's always kind of fun to talk to the press. Okay, with that said, introductions out of the way, why are we going to look at what we call alternatives? So alternatives, essentially they have performance that has a low correlation to traditional investments, and they may improve diversification, lower portfolio risk. So what that really is talking about is strategies for all market conditions, whether it's non-directional, sideways markets, bull markets, bear markets. And, we're not just going to passively buy and hold. If you do, you can sometimes run into some major hiccups. Prices don't always go up. Here's the Mag 7 lost over 5 trillion from their all-time highs here. You can probably feel a little more of that pain today, although I haven't looked in the last bit here. These things change on a dime. Here's what it looks like on a graph over the last month or two. Actually, no, that's 1 month. And even stuff like crypto, highly speculative, had a huge run, obviously, but now, Bitcoin is really, I think it's off more than 50% from its all-time high. So the point is, you can't just buy and hold and expect that it's going to be smooth sailing. And we're going to talk a little bit about that and how we try to navigate through, I guess you could say, the noise. And there are really three barriers to trading that we've identified really from our clients. And I think we can all relate to these. So let me know what you think if we've kind of hit it on the head here. How about information overload? There's just noise. We used that term just a minute ago. Conflicting targets, opinions, narratives. And really, it's a lot of clickbait. And how about this? How about the tweets you get? From 1 minute to the next, you get a tweet that just kind of rocks the market, the headlines, whatever it is. Years ago, you'd have a guy or gal sitting behind their desk and using a graph paper and a pencil and doing charts or looking at balance sheets. But that's really not the way it works so much anymore. It's based on momentum. It's based on flows, systematic trading, a lot of positioning, automation, totally different landscape, and you end up with this information overload, can hinder your decision making. You get analysis paralysis, and how do you know what is or isn't important? So that's a big problem. This guy here, I think, represents all of us. Too much info. And then what about time? Realistically, it's not really practical for us to spend time watching our screens during the market hours. Even those of us who have some free time probably would rather not, you know, be doing this. All this is kind of funny here. This guy here says he's managing his $180 portfolio with this looks like an IMAX theater system here set up. That was kind of funny. So this is how people envision their trading setup, but the reality is most of us don't even have the time to do it. So you really probably shouldn't be trying to watch your trades all day. You probably find that counterproductive regardless, because why? Well, our emotions get in the way. This would be barrier three. When it comes to making money or losing money, that's a lot of fear and greed gets swirling around in our heads. We end up riding that emotional roller coaster where, as you're doing well, you get euphoric, and you start doing poorly, you raise that white flag of surrender, capitulate, and then you kind of get back on that same ride again. We want to try to avoid that. We want to try to control our emotions. And that's what we're going to help you with here with some of these automated strategies using options. So we think we can jump those barriers and overcome those hurdles. So before we jump into the demo, just real quickly, let's put some options trading in perspective. Remember, the buyer always pays the premium and the seller is collecting that premium. So if you're the buyer, you're said to be long and you pay the premium, whether it's to buy puts or calls. And then who collects that premium? Well, the seller. And you can of course choose to be a buyer or you can choose to be a seller. And long option strategies where you pay a premium, those can be called debit trades or debit spreads. Here's an example. In a bull market, the market's moving higher, maybe you're bullish, you might want to buy some calls or buy a call spread if you think the market's going to keep going higher. And conversely, if you're bearish, maybe you want to buy some puts or some put spreads if you think the market's going to keep dropping. So those would be debit spreads where you pay the premium. And then there's also short strategies. So you take the opposite side of that. Perhaps you're bullish here, and what might you want to do? Well, maybe you sell some out of the money puts and collect the premium if you think the market's going to keep going higher. Or if you're bearish, you might sell some out of the money calls. Or perhaps you look at the market and think it's going to go sideways for a while. You might sell some calls above the market and puts below the market. That's called a non-directional or neutral strategy. And you're collecting premium, and that's a credit. You receive a credit for making those trades. So we're going to learn two letters of the Greek alphabet, and we're going to keep it real simple. You can get really deep into the weeds on this, but we don't need to. Delta. This helps determine probabilities, and it is what is the option value change with a change in the underlying index. So how much um, does that value change? That's really what the formal definition of delta is, but option traders look at it like the approximate probability of that option expiring in the money. So example, if a delta is zero point 0.2, that means there's a 20% chance of expiring in the money, but an 80% chance it expires worthless. Remember, delta is not static. It always increases and decreases, moves up and down with price movement and time. And it is not the probability of a winning trade. So keep that in mind as well. And speaking of time, we'll look at theta, representing time decay or sensitivity to time. Remember, every option has an expiration date. It runs out of life, has a limited lifespan. So time is referred to as theta. When speaking of options, it's a negative number and it equals 1 day of time decay. And here's what it looks like on a graph, essentially. Let's say you had 120 days on the option and you approach time zero, and the value of that time decreases and decreases and decreases. You have theta decay. So basically, the clock is ticking, you're running out of time. And eventually, the theta decay always ends up at zero because you run out of time. So that's how that works. And essentially, also in the last 30 days or so, the rate of change on the theta decay tends to increase quite a bit more versus when you're further out on the time horizon. And so there are various strategies to use delta and theta, and we're going to look at a few of those. And we want to look at how the professionals trade, maybe an institution or a hedge fund might trade. So what might that look like? Here's a little piece here I found on reasons why selling options is better than buying options. I highlighted a few of these here. So they talk about professionalism in managing risk like a professional. It's a professional approach distinguishing option sellers from novice speculators. So I think I agree with that. What they're referring to there is oftentimes the rookie will just buy a simple call option and hope to hit a grand slam. And while that may work once in a blue moon, over a long period of time, it's really not going to work. But here's another comment here on selling options here. It's often preferred by long-term investors who value consistency over high-risk speculation. And then ChatGPT said this, why do professionals sell options? Well, you take advantage of that time decay. We just looked at that, and you're collecting the premium, and you know that at some point the time will run out on that option. There's a higher probability of profit when the seller that receives the premium up front. They talk about income generation. They look at market neutrality. We mentioned that too. Option sellers, you have ways to trade in sideways markets. And essentially, they say selling options is a preferred strategy for many professionals. And Wall Street pros will trade a lot of option spreads, and they're using theta decay to their advantage. So they collect premium from buyers to offset their cost. So here's what a typical spread might look like, where you collect premium. Here is a an example where maybe you're bearish, and for example, you're selling an out of the money put spread and you collect premium. So here's an example here where the market trades, and well, I'm sorry, this is actually a if you're selling this out of the money put spread, then you would actually be neutral or perhaps bullish. I need to correct that. Sorry about that, folks. But so you can see here, you collect premium for selling this out of the money put spread, and the market just kind of trades a little higher here, a little bit higher, and then you can see where the arrow is in this blue square under the RTI, and we'll explain that indicator in a bit, but that's where you close out the trade. So you sell the spread down here, you collect a net premium. So the red line is the one you sell, the put, and the blue line is the one you buy, and you have to pay money for that as protection. And then over time here, as time goes by and theta decay works, then you essentially close out the trade. So you sell it, and as time goes by, you're able to buy it back for less than what you originally sold it for. Then here's something called an iron condor. It's non-directional. So you take a call spread that's out of the money and a put spread that's out of the money, and you sell those simultaneously. So you collect premium on the calls and the puts. And then you look for the market to stay within that range, essentially between the two red lines. You can see here it's dropping and dropping and dropping, and it goes back up and so forth. And right here, you get a signal. It turns blue and says close out that position and take your profit and move on. So you place the trade by selling it and collecting premium, and then you wait for theta decay, and then you buy it back later, hopefully for less than what you sold it for. And we're going to show you how to automate this too. So when it turns blue, you don't have to do anything. The order can automatically be placed for you. And then here's a strategy called a dragonfly. It's a variation on the condor, sort of a non-directional strategy. And again, you have the call structure and the put structure here, where this is all done simultaneously as one order, and you collect premium for placing this trade. And you can see the market sort of chopping around, going down, going up, and then again, as theta decay works, then you buy back that position for less than what you originally sold it for. And you can see here the margin of error between those red lines is quite large. So really, you have all this room for the market to bounce around and for theta decay to work. It's magic, so to speak. And then there's directional strategies as well with spreads, or even just outright positions, whether you're bullish or bearish. Something we call a bull hedge. If you're bullish, it's a combination trade, and you simply buy an out of the money call spread, and that's a debit spread that you pay money for, but you simultaneously sell an out of the money put spread, and that's a credit spread. So you use the money from the credit spread to pay for the debit spread. So you can often do this for a credit, so it doesn't cost you anything. And if the market moves higher, then this would do well. If it went sideways, it really wouldn't matter because you did it for a credit anyway. And if it even dropped a little bit, it would be okay too. The only thing you have to worry about, of course, is if it really dropped quickly, then you'd have to cover your risk on the short put spread. And we'll show you how to do that as well. And that's automated, just as the profit taking can be automated. And we just looked at a bullish position. Here's a bear hedge where, again, you collect premium by selling an out of the money call spread here, and you simultaneously buy an out of the money put spread, often for a credit. We typically only do these for a credit, or maybe neutral or even money. But that's just an example of some of the directional strategies that you can use that don't cost you anything. So keep in mind, we mentioned it briefly, but rookies do this one thing over and over, and that is majority of small time traders are buying the most basic call and put options, and they have a much lower probability of profit versus advanced strategies like option spreads. So we don't want to do what rookies are always doing. And even here, this gentleman, John Foley, he's CEO of Options AI. He says everybody in the business knows that if you're only buying out of the money calls, you're likely going to lose money over time. So we'll look at professional strategies driven by technology. That's what our ThetaTrader software does. Our proprietary algo will create these theta trades, these one-touch responsive alerts, bull bear flat market conditions, and we use automation for risk and profit tracking with that risk thermal indicator. That's the color-coded strategy. So we'll go ahead and let me switch screens while I jump into, let's take a look here. Oh, wait a second. Okay, give me 1 second, folks. Okay, I'm in the right spot. Okay, now you're looking at my screen here for the ThetaTrader dashboard. And it'll look really similar to yours. Some of the menu items will be different, but this is a demo account I use for presentations and webinars and so forth. So up top, you'll see active trade alerts, and here you'll see the theta trades for the day. There are bullish strategies, bearish strategies, or neutral, non-directional, and you'll see the three markets we're focused on. Those are the E-mini, S&P 500, NASDAQ 100, and Russell 2000. And you see all the strategies here are already pre-populated for us, whether you're bullish or bearish or non-directional. And you'll see on the dashboard any open short positions, basically any short spreads, premium collection spreads here, anywhere from 37 to 68 days on these trades here. Any open bought positions are down here. And then this is your account information all integrated with your Altavest trading account. So ThetaTrader works with your Altavest trading account. So that's just kind of a brief review of the dashboard, but let's look at a couple trade examples here. So we'll look at a neutral strategy and we'll look at the condor. It has 37 days till expiration for the July end of month, and see the strike prices are already pre-selected for us. And you'll see your maximum profit potential at expiration, targeted annualized return at expiration. You don't need to know those things. It's all explained, but just thought I'd point it out. And you can see the graph. So here's the current price. You're selling an out of the money call and put spread simultaneously and collecting premium. Here's the expiration date right here. And we'll look at some of the details. Let me expand. That should be good. You can see that okay, hopefully. So you'll see 37 days till expiration, your settlement value, put risk, call risk, commissions, cash required. And the main thing I want to point out here is you're selling a 6,700 put, and the delta is 9.03%. So that means there's over, it's just basically a 91% probability that this put you're selling to someone else will expire out of the money. And then look at the calls, 4.77, so 95% plus probability that the calls you're selling to someone else will expire out of the money as well. So again, you're looking at the chart, you look for the market to stay in this range between the red lines. That's really what it amounts to. And then the default is a sell because you're selling and collecting the premium. You can change the quantity up or down here, and it changes everything here. And we'll just go ahead and do 6 of these just for the sake of the demo. And it just shows that you're filled, and that's it. Now let me show you the dragonfly. here's a dragonfly strategy. And you can see there are anywhere from 33 days till 68 days of expiration trades to choose from today under the dragonflies. And you can see the calls you're trading here and the puts you're trading here. So again, stay between those red lines. That's what you're looking for. And that purple vertical line is the expiration. And you'll notice again the same kind of information, but the cash required is higher than a condor because you're trading in increments of 4 puts and 4 calls every dragonfly. And then for each option that you're short, you buy an option as protection. So I don't want to get too deep into the weeds, but see you're selling 4 of these calls, but you buy 3 further out of the money and then 1 closer to the money. So these are all coverage strategies, never naked, and it's the same structure on the downside. And the dragonfly is a little more risk averse, has a little less profit potential, but still you have these higher probability outcomes with the puts and the calls that are being sold. Over 90% probability and about a 93% probability that these puts and calls you're selling to someone else will expire out of the money, and that's based on the delta. So we'll go ahead and why don't we do 5 of these? And there you go, just that easy to place a trade. And now let me show you, there's also a trade simulator as part of ThetaTrader. Let me squeeze this down. I want to show you sometimes the difference between a condor and a dragonfly. You can use these buttons here to go backwards and forwards in time. And this happens to be a trade from, let's see, April 30. And we'll just watch and see what happens here. This was just a trade that was available on the website at that time, this June Iron Condor for the S&P 500 mini. So you can see here it's kind of trading still below the red line, the short call, but it's turning yellow, turning green, and all these colors essentially telling you that green is good, yellow is elevated risk. See, the trade is a little negative still, just because it's getting closer to this upper boundary here, but still do nothing. Then it turns green again, so the trade is maturing and theta decay is working. And then you get a profit taking signal here, and you can automate this. So when it turns blue, the orders are automatically placed for you. So the nice thing about this is you don't have to watch this day by day. ThetaTrader is tracking it for you, and it will place that order for you and manage the risk for you. So that is on June 12th, you close out that position on the condor. But what if you had done a dragonfly? Let's find out what happens. What's the difference? So the market's doing the same thing, obviously. And you have some yellow RTI here that says, well, market's getting a little nervous, or at least the position's getting a little nervous. You're getting orange, elevated risk, but still don't do anything. And look at this, you get a profit taking signal on June 8 with 11 days till expiration. And you compare that to the condor where you had to stay in that trade, an extra 4 days or so before you could close it out. So the dragonfly can sometimes mature more quickly than a condor, which is a really good selling point for the dragonfly. And then there are times where a dragonfly will actually be more robust and will not trigger an exit signal, and a condor will. So that's the trade-off. The dragonfly is a little more risk averse, has a little bit less profit potential than a condor. And then here is, any number of bullish strategies you could use. Here's an example of a bullish bull hedge that we call and the colors are different. They have a different meaning when you're bullish, with a debit spread versus a credit spread. But you can see here, the market rallies. And of course, this trade would do very well because you sell this put spread, you collect money, and you pay that, you buy an out of the money call spread. And then of course the market's rallying, and that would do very well in a situation like that. Here's a bear hedge, just the opposite. Maybe you think the market's going to be bearish, but actually what happens here is really nothing. Even though it drops, the trade still expires, but you were able to placed the trade when you started the trade at a small credit. So that's one of those things where it doesn't really go anywhere, but it still didn't hurt you. And of course, if it did run against you, then you'd have to cover the risk on the one side. Now, I want to point out too, we have research available in our ThetaTrader platform. You just go under the account section here, you'll see Trade Scope, and it's a daily proprietary research piece we put together. We look at a few graphs and look at the global macro landscape and some other identifying flows and so forth with options flows. But that's just 1 or 2 pages. So it's really convenient for people and clients. They like looking at that. And let me show you how to handle your settings now. So you go into the account section here, you go under settings, and this is important to activate your risk manager. You click that button there, and then you can use the default level of 0.50, which is what we're using here in the demo, or you can use a different level, 0.38, or a custom level for your risk. You can go anywhere from 0.5 to 0.25. And just keep in mind, if you go down to 0.25, your losses per trade will be smaller versus say 0.38 or 0.50, but you'll have more frequent losing trades. The magnitude of the losses will be smaller, but the frequency will be higher. So I just use 0.50, and you just go ahead and save those settings. And then you can save the settings for your profit directive as well. So you just check that box and save your settings. So what happens is when you reach particular profit thresholds, it will automatically close those positions out for you. And here's an idea here of, you don't have to look at all this right now. I'm just showing you in the glossary. Here's how the color coding works for the risk thermal indicator. It's all explained here. So it's very helpful. And then I also wanted to point out what might be, I think, perhaps the best feature of all. So if you notice, we'll go back to our dashboard here. You'll see these trade alerts that are here. So there's 2 trade alerts for the day. The first one here, you can see it, excuse me, I've got a frog in my throat. You can see here we're doing a July week 2 NASDAQ 100 call spread, and then you're buying a put spread in the same expiration. Okay, so this is an alert that would come to you in your account if you didn't have any similar positions and if you had available capital. So that's the nice thing about these alerts. They're specific and they're tailored to you and your account. And you can see a brief explanation here of the trade. And I'll point out here the quantity. It's all pre-established for you in your account. Increase that just a little. So you don't have to do anything other than read it, and then you can decide whether you want to place the trade or not by accepting it or rejecting it. But you can lower the quantity if you'd like. You cannot increase it, increase the risk. But maybe you want to do 16 of these for whatever reason, or 14 or 12, and you can certainly do that. And you can see all of the premium numbers and the cash required numbers changing along the way. And then we'll go ahead and just accept that trade. And it's just that simple. Now here's another alert. This is for a dragonfly. This is the August in the month dragonfly. So you can see the structure there. You're trading these calls and you're trading these puts, and it's a non-directional strategy. You look for the market to stay between essentially those red lines. And again, the quantities are pre-selected. We'll go ahead and just take it for the suggestion there and accept that alert. All right, folks, so that's how simple it is to use the ThetaTrader dashboard. And I want to show you, let me switch gears again. Let me go ahead and show you how this works with your phone. So we're going to look at these one-touch alerts using your phone. That's how most people use them. So these are, again, these alerts are live. They're integrated with your Altavest account. All you have to do is touch accept to get that order placed. It's just that simple. So here's an example. You'll get a text message. It's a link. And you'll click that link. And it will take you to the alert page. Very similar to what you just saw. So this happens to be an alert for another dragonfly. Those are the calls, those are the puts. There was the market trading. That purple vertical line is the expiration date. I should also point out that all these trades are going to be closed out before expiration date. So there's the quantity. You can move that lower, but you can't go higher. See, it won't allow you to move higher, but you can go lower. And it explains the premium you're collecting and how much the cash required would be, or your margin deposit essentially. And then you like it and you just touch accept, and it's that easy. So here we go, folks. Let me show you how to get started with ThetaTrader. So ThetaTrader is the software that we just saw, including all of the theta trades, the risk thermal indicator, the color coding, the trade simulator, everything you just saw, valued at over $3,500. And then that also includes the one-touch trade alert technology. We just saw a demo of that. That trade alert technology is valued at $4,400. And I don't think you've ever seen anything like it. I know I still haven't seen anything like it after all these years. But so you get all the features that we just discussed here, plus you get us, private coaching. It's not just technology where you don't ever talk to people. This is part of what we do is we offer the one-on-one coaching. We're all licensed, we're all experienced. We'll do like a screen sharing session. And I just asked AI a little bit ago about private trading coaching, and they said here packages with experienced mentors range from $5,000 to $15,000 for a 6 to 12 month period of time. And I would suggest that that's probably a little bit low, because I've talked to people that are paying $25,000. So in that sense, I think it's a great deal where you get to work with all the technology and real people. But I think the value here, even at $10,000, is probably undervalued. But we'll be your co-pilot. We'll discuss your trading strategy, your trade history. We can review that with you. You'll develop a relationship with us. We're all, again, licensed and been doing this many years. So everything you've just seen in ThetaTrader, the technology, the alerts, the automations, the coaching, valued at over $18,000. And there's always more, right? There's always that infomercial kind of thing. You just wait, there's more. We don't want you to forget about the daily research newsletter, TradeScope, and that's all only available and exclusively available to our ThetaTrader clients. And if you've never traded futures or options, it doesn't matter. We've got you covered because we have a futures and options masterclass. So we'll give you everything you need: futures basics, stock index futures, options reviews, options on futures, spreads, advanced strategies, you name it, it's all covered. It's almost a $2,000 value for that futures and options masterclass, along with the TradeScope newsletter. So that's really the research and the knowledge and the learning that you need. If you need it, it's available for you. It's all part of the ThetaTrader package. Then there's online tutorials. I didn't show you that because we don't have a lot of time, but I wanted you to know that those are available within ThetaTrader, short video tutorials. So again, just to summarize, you have the ThetaTrader software, along with the alerts, along with the personal coaching, all of the information, knowledge, training, research, everything available as well, valued at over $21,000. And of course, that's not what we're going to offer that as. And we used to do this package for $4,000 in live or in-person events. You'd have a table at the back, and we'd have a great time with people, meeting people and presenting, and then people would sign up at the back of the room for $4,000. But of course, we can do a lot better than that. This is our retail price here if you go to the website, but we'll do even much better than that for you for the Traders Corner event. And this is just a one-time payment, and this is a lifetime membership. So I want everyone to pay attention, because sometimes people get the idea that, oh, well, this is every month or whatever it is. But no, it's one payment of only $497. So you can use the QR code. You can use the link cf.altavest.com/TT. And that's my number. That's my email. And it does expire though. So we want to get you on board and sign up. And we'd love to have you, join us and on board with us. And really, there's no excuse, because let me tell you why there's no excuse. For one thing, you can get a rebate if you have $100,000 or more in your account. We'll rebate that entire membership 25,000 and above, you get a 50% rebate. And more importantly, there's a money back guarantee. So you have no risk on the membership fee, folks. So really, really the thing to do is you get yourself signed up, become a member, and then you'll receive your login credentials. You'll start getting the trade alerts right away. You can start using some of the theta trades and the platform yourself, and you've got really 30 days to use it. So if for some reason something happened, you changed your mind, then that's fine. Just ask us and we'll just rebate that membership fee for you. But really the best way to do it is to sign up, get yourself started. And how about some FAQs? How about advantages of E-mini options? Well, there's a lot, but they talk about defined risk, reduced volatility exposure, improved probability of profit, cost-effective directional and range strategies. So we looked at that, directional and non-directional range strategies, better time decay, so you're capturing that theta decay. And they talk about one thing here that we didn't get into, but execution and liquidity. That's really the big reason you want to be in those E-minis. They're so deeply liquid. You can get the execution on those. They call them multi-leg execution, multi-leg combos, multi-leg execution. So that's a big selling point. So I wanted to point that out. When you're doing a trade like the Dragonfly, that's six different option strategies, or I'm sorry, six different options, period. And you trade that all as one order at one price here. And you can't do that with security. So that's why we like the E-minis a lot. Big advantage. And also, if you're doing just a couple markets, you don't have to pay attention to the 6,000 other markets. So you've got these premium collection spreads, so limited risk professional strategies, customizable for any size account, higher probability outcomes, looking at the deltas if you're selling premium and collecting premium. And then these are flexible strategies. Any market condition that we kind of looked at, whether the market's up, down, or sideways, there's always a position or strategy available. Then you have that wide margin of error when you're doing premium collection. So you don't always need to accurately pick a direction. So for example, here's just a trade from yesterday. You're selling these 8,025 calls, that's the red line, and the 6,350 puts, that's the red line here. So you have over 1,825 points between the short calls and the short puts in this particular example. So that's a really very wide margin of error. And so you've got those short option strategies where you collect premium. Again, non-directional. You want the market to stay in those green lines. Or maybe if you're bullish, you might want to sell some out of the money put spreads. You could do that too. If you're bearish, you might want to sell some out of the money call spreads. You could certainly do that. You're collecting premium in all of these cases here. And then there's also long option strategies or debit spreads. They can be useful at times, and they offer limited risk, but they all have a asymmetrical return profile. So they do have a lower probability of outcome. That's because of the delta, of course, on those. But if you do have a winner, they can be a nice winner. So here's an example where even a non-directional long option strategy like a straddle could work. If you're thinking there's going to be a big move up or down, you could certainly buy some calls and buy some puts simultaneously, look for a big move up or down. If you're really, really bullish, you could certainly buy a call spread, a debit spread. So you buy a call spread here, or if you're really, really bearish, you could certainly buy an out of the money put spread. But again, those are lower probability outcomes, but they do have a higher potential payoff. And another advantage, there's no margin calls when trading option spreads the way we do it, because all of our strategies are covered. So we're not doing any naked options trading. These are all covered strategies. So there's no unlimited risk and there's no margin calls. So you don't have to worry about that. And there's tax efficiency when trading on the E-mini options and futures. So what we're talking about is these are called 1256 contracts as identified by the IRS, and you get favorable tax treatment. 60% of the gains are taxed at the capital gains rate versus 40% taxed at your personal income tax rate. So for most people, that's a big tax benefit. And there's no more itemizing as well. You receive a 1099 with your profit for the year, and that's just that one number that you would use for your taxes, and that's all you have to use. But of course, always consult your tax attorney or your tax advisor for details on that. Then people ask us about IRAs. Absolutely, we work with Equity Trust, and you can do a self-directed IRA with us as well. And Equity Trust will actually waive your setup fee. If you come to them and you say you're with Altavest, then they'll waive your setup fee. So they're great. We've been working with them for many, many years. We've got about, well, I bet they have more than now, but 71 billion as of June of last year. I should get that updated. So they do a great job. But remember, we're full service futures and options brokerage. So we can also do more than what you just saw. So if you're interested in any of these other markets, we can certainly do that as well. And we think it makes a lot of sense to diversify your portfolio with these alternative strategies using automation and what they call non-correlated option strategies. You can speculate or hedge your stock portfolio. So there's that gray slice of the pie there and alternatives. And that's really what this is all about, kind of having an ability to be flexible, go anywhere strategies where you're not just relying on being bullish all the time. All right, so to summarize some of the key benefits of what we just looked at, these are flexible strategies for all market conditions. Professional credit and debit spreads are simplified and automated. Convenience of automation for risk and profit controls. Uh, Diversify or hedge with this non-correlation. If you've got uh, stock portfolio or something, maybe you want to buy some put spreads as protection, you could certainly do that using ThetaTrader. You've got the tax efficiency, you have those one-touch responsive alerts, and again, we mentioned no margin calls. We're only doing covered option strategies. So I know that's a lot of information, and you probably have some questions. I'm always available afterwards. I might be out of time, a minute or two here to go, but I'll just leave it on this last slide. But again, 30-day money back guarantee. So you don't have any risk on getting signed up, getting your login credentials, and starting to receive those alerts right away. You might like to see what we're doing and kind of take a peek and sort of, even test drive it in some way by getting signed up and finding out exactly how we do things. All right, I think let's see if there's any comments or questions. I'm not sure here. Let me see if I can find those. I think I've only got about a minute here. Let's see, do I have any comments or questions? For some reason, there we go. Yeah, thanks for putting up the offer there, Anthony, but I think that's it. I see comments and questions, but I don't think I can get to them all.
Okay.
And the best thing to do is just call me and
Uh, I could say a few of them if you can't see it.
I see now. What time are the alerts sent? Market hours, during market hours, and some Canadians are accepted. You just have to tell us what province you're in, and then win loss. Give us a call, and I'll tell you how that works as well. We don't have any. We don't promote any track record because we don't manage money formally. So from a compliance perspective, everyone has a self-directed account and everyone accepts trades differently or not accept them or modifies them in their own way sometimes. So it's not really apples to apples, if that helps answer the question. Best thing to do is actually just get registered and signed up and start receiving the alerts yourself. And